Hey, good morning, everyone. Welcome to the macro snapshot. We are Thursday, February the 12th, 2026. Okay, let's have a quick look and just see what happened yesterday. We had the much stronger than expected non-farm payrolls, which also came with revisions. I just want to start off by looking at a few charts of the SOFR contracts, the short-term bond short-term interest rate contracts here. So you can see here on the implied yield, if we look at the March 2026 contract, you see here that the yields went up from about 3.59 implied up to about 3.64. So got about 5 basis points move more hawkish up there. And you can see if we go into June, even a bigger move here. Then if we go into September, and then into December 2026, you can see that the initial move more hawkishly was the further out you go in 2026, the more that the market sort of brought that back and basically came back to about 50% of the move. So what is that telling us? Overall, that's telling us that the market is expecting from yesterday, priced in a slightly more hawkish path of the Fed. And another way of looking at that is to look at seeing what's priced in. And again, if we look at sort of the amount of cuts or basis points priced in by the market, if we look at the March 26, you can see that expectation went from about 6 basis points of cuts priced into about 1, so almost nothing at all. And then if you go out to the middle of the year, you can see that also was repriced hawkishly from about 28 basis points of cuts down to about 19. And then if you go out to the end of the year, again, similar kind of thing we just saw. You can see by the end of the year, actually, let's go to the end of the year. Let's go to December. You can see that pre NFP, we're looking at about 55 basis points of cuts. That reached a maximum intraday down to 43. So what's that, about 12 and a half basis points? So that's actually a whole half cut was taken out at the peak of hawkishness yesterday. But then by the end of the day, you can see that's been taken out. So, but the bottom line, and again, we can look at a couple of other charts here. The bottom line is that the market reacted hawkishly on those strong numbers. And again, just a couple of different other ways of looking at that. You can see intraday here. So we've got here where the data was released at about 8:30 or so. And you can see here that, this is the June pricing. You can see here how it went up very sort of hawkishly. You can see here was starting out at about 27 basis points, went to about 17.5 basis points of cuts. And then intraday, you see how that came back. Whereas what's interesting yeah, so that's what we had for the in the black here. But if you can see here, the 10-year yield, that actually came back a little bit more. So the bottom line here, and again, just to look at another little chart here, is just you can see, well, actually, we've just gone through that. So the point here is that it was sort of fairly hawkish, but the longer term bonds, those yields came down a little bit, whereas at the front end, essentially the market repricing a little bit more hawkishly. And if we can actually just now have a look and see just the FedWatch tool, we can just see what that looks like. And you can see, for example, here for the let's say the let's say the March meeting here, not a huge amount of difference, but basically compared to, let's say, a week ago, you can really see that a lot less sort of dovish. If we go out to April, you can also see that the expectations of cuts have come in a little bit. So bottom line, too long didn't read a kind of summary is that the market found that the numbers a little bit hawkish and repriced that. But it's slightly ambiguous. I mean, let's just have a look at some of the numbers as well. I've got some charts here as well, just to look at them. We just go through to recap. So you can see here that what we have is the month-on-month change in the overall payrolls. You can see that gradually that's sort of pushing up a little bit. If we have a look now at the total number of private new jobs, you see that came in pretty positively. But let's just look at the trend. You can see the trend is going up there. And if we then look at the next chart, which is the government numbers. Now, the government numbers in terms of government jobs, that was negative, but you can see the trend here is less. So what the trends seem to be telling us is that the government layoffs, remember the whole Doge thing when Trump came in and Elon Musk and whatnot, that does seem to have reached a peak redundancy and peak layoffs for government workers. And that seems to be sort of coming back, if anything, or at least less negative. And if we look at the number of sort of private payroll jobs, that does seem to be picking up. So that raises the question, if we have less immigration, a smaller pool of workers growing, and maybe sort of less government layoffs, does that mean that we're maybe getting to a kind of a sort of a nice sort of equilibrium here where maybe there's not a huge amount of jobs being created? And certainly that doesn't seem to be the case. But just enough jobs to really offset the number, the sort of the lack of workers. So that's a relatively sort of positive kind of situation here. And if we look at the average hourly earnings. The issue here, though, is interesting. If you look at things like the US dollar, it didn't react very well. Initially, it reacted quite well. We'll get into that in a second. And I just wonder whether that sort of continuing sort of weakness in the US dollar may stabilize. If we continue to get positive data, we have, let's say, initial jobless claims this morning. If that comes in, sort of fairly strong, and then maybe CPI is slightly sort of hawkish. I mean, does that mean that the US dollar might stabilize and even start to sort of strengthen a little bit? Because I'm just wondering why that's not happening. And I understand all the big picture things about dollar de-dollarization and debasement and lack of Fed independence and all of that kind of stuff. But the reality is that the markets are still reacting in terms of Fed pricing in a fairly orthodox kind of way. But what is interesting here is just to see what happens to the average hourly earnings, because the average hourly earnings had been going down, as you can see. So let's see if they start to stabilize. And yesterday we had the average hourly earnings were actually a little higher than expectations. And if we go back and look at the numbers and see that in prime age, so which is 18 to 54 age, so 18 to 54 is classified as sort of prime age group. The participation rate there is above 80%. It's like 80, 82%. So that does seem to indicate, and I'm not talking about old people, I'm not talking about that younger cohort of, let's say, 16 to 24, which still have relatively high unemployment rates. But if you look at the 18 to 54, that sort of demographic group actually almost seems to be having a full employment. So the question is, will average hourly earnings start to tick up, and will that be reflected in maybe the economy has actually gone through its lowest point? That's going to be interesting. That's what I'm trying to say here. Will all those things pick up? Now, in terms of the inflation as well, we've got CPI tomorrow, but let's just look at inflation as well. As I say, yesterday we did get slightly higher than expected average hourly earnings, but keep in mind that earlier in the week, the employment cost index was actually lower than expected. So on inflation, there are sort of mixed readings here. And if you actually look here, inflation swaps, you've got the 1 year inflation swap in blue. You can see that was going down, and then it picked up a little bit, but it's starting to go down a little bit again. And you look at the 2 year inflation swap, that's also starting to go down. So the point I'm trying to make here is that also, if you look at the CPI medium forecast, that's actually also starting to tick down. So what is interesting is that could we, just stepping back, be looking at the following situation, that inflation is, in some parts of the economy, maybe services a bit sticky, but overall seems to have sort of peaked out and seems to be at let's just call it an acceptable level. The jobs market seems to be okay, and a lot of that is driven by the lack of immigration, and the pool of workers is not expanding. We're not creating a huge amount of jobs, so maybe we're creating enough, at least in that prime age group, to keep things quite solid. And if that is the case, does that mean that despite, problems potentially with AI and sort of layoffs due to AI, which is another wrinkle and complication, will we start to get some wage growth pick up, some, extra wages are sort of starting to pick up a little bit, which will start to drive economic growth? So that's really the things we need to be looking at. We need to be looking at the unemployment rate, which of course came down yesterday, 4.3 down from 4.4. But we need to be looking at wage growth. Is that going to be solid? Because ultimately, what's going to drive the economy is going to be the wage growth of sort of, let's say, normal people. On the other hand, some of the negatives, we also have to be looking at, potentially the impacts of AI. Is that going to be causing some redundancy? So kind of an interesting moment, but overall, sort of gun to my head, someone dropped in from Mars and said, hey, what's happening with the US economy? I would probably say, well, there's kind of a relatively sort of stable labor market, not amazing, but certainly not falling off a cliff. There's a little bit of problems with the older people and sort of very young people, but sort of in the middle, it's okay. Wage growth is, reasonable without being very, very solid. There are some concerns about artificial intelligence. Is that going to cause a lot of that sort of middle management, to be laid off, white collar kind of jobs to be laid off? And inflation is, sticky in parts, but relatively acceptable. That seems to be essentially where the economy is going. So that would argue for, a relatively strong economy. Okay, so let's just look at a few things. So keep in mind that today we have the initial jobless claims, continuing claims coming in at 8:30. That's going to give us a bit more information just about the weekly jobs, but that's been pretty strong recently. In terms of other markets, let's just look at a few charts here. Um, and I will go back to my basic charts here. So if we look at, let's say, volatility, the VIX is coming down a little bit. If you look also at the bond volatility, that actually is starting to come back down a bit. So, in the broad volatility regime, we can look at things like gold as well. You see how gold is coming back down a lot. You can see silver is coming back down a lot. So the whole volatility complex overall is not bad. It's becoming less volatile, and ordinarily that's going to be a positive, let's say, for the equity market. And also, while we're talking about precious metals, as that volatility starts to reduce to reasonable and acceptable levels, that could also start to be a catalyst for institutions to get back in. But if we look at the equity indices, you can see here that it was kind of interesting intraday price action yesterday, because you can see here it looks sort of unchanged on the day, up and down, but it was quite volatile. And you look at the Nasdaq as well, you see that up and down. And then we look at the Russell, which we will try and look at the Russell up and down. And essentially what happened is that when the data came out, there was, sort of a strong, sort of a positive move. But by the time the market digested the information, it was like, well, hold on, does this mean there'll be less Fed cuts? And as we saw at the beginning of the video, indeed, the SOFR market and the short-term interest rate market essentially did, reprice a little more hawkishly. And I think what happened is that the equity market essentially said, well, hey, potentially less Fed cuts, a more hawkish forward pricing, and maybe that's not so great for equity. So we did see a bit of a sell-off, but as you can see overnight, a sort of a modest rebound, and the market essentially sort of unchanged from 24 hours ago, and saying, well, maybe a few less Fed cuts, but at the end of the day, the economy does seem to be doing okay. So maybe that's where we're getting into, is just the equilibrium on the indices. But as always, if we start looking at some of the subcomponents, and I don't want to belabor this and flog a dead horse, but if we look at the equal weight, you can see that actually didn't really sell off particularly yesterday and has pushed a bit higher. And then you see, as always, look at the semiconductors pushing higher, even in the pre-market, much higher at 418.65. So, the semiconductors, and our dear old friend, the software, had a little bit of a reactive bounce, but boom, as I was indicating yesterday, couldn't even make it to a 38% fib retracement. So you see the software index, IGV, already sort of falling down. You see the Mag 7s also falling down. So, these same sort of rotations seem to be in play. The broader index is doing okay, but sort of flat. Underneath, we see the semiconductors doing super well. We see small caps and not momentum and growth. Momentum and growth actually underperforming, but value doing quite well. And then we're seeing just the pure software plays doing quite badly. And again, if we put on the old sort of index here, which is essentially long a basket of QQQ and the semiconductors, and short, like a butterfly, the software, you can see that that's pushing to new all-time highs as well. So the point I'm trying to make is that the broad US equity indices are sort of choppy and a little flat, but underneath we're definitely getting sort of outperformance and underperformance in the different sectors, especially in the technology sector. So nothing changes there. On the other hand, global equity, very, very strong. Again, if we look at it's interesting here to look at the ratio of SPY, as a sort of a proxy for the US versus the Europe and Far East ETF kind of developed markets. And again, you see SPY completely underperforming the rest of the world developed markets. If we look over at Europe, you see Europe had another very strong day. If we look at Japan, the Nikkei is ripping higher after the election of Takaichi, so that's doing super well. You look at emerging markets, let's look at, for example, Brazil. Look at the Bovespa ripping high, a bit of sideways consolidation. If we look at, actually, I'm not sure about India. I didn't look at that, not doing so well. But if we look at the Kospi, now the Kospi, of course, Korea, very heavy with the semiconductors, with the memory companies which make memory disks and whatnot, SanDisk companies like that. This is just a one-way train going up, this amazing performance. And then if you look at the emerging markets, you look at emerging markets here, a new all-time high, emerging markets excluding China doing even better. So again, these themes continue to play out, which is essentially US indices kind of okay with a lot of rotation under the hood. The rest of the developed world, so let's say Europe, Australia, and let's say Japan doing very, very well. And then you've got, globally, you've got the semiconductors doing very well in places like Taiwan and South Korea and emerging markets. So a lot of this money is also flowing into emerging markets. And those themes basically been with us for a few months and continue to work. And maybe that's something which is, some of those, all of these dollar flows, maybe there's a lot of dollar flows, incrementally 1% here, 2% there, going to the emerging markets, going to other developed markets. And that is what ultimately is causing the US dollar, apart from the big macro and geopolitical stuff, to just find it hard to rally. Now, if we look at the bonds as well, interesting what happened yesterday. I can see here, I don't want to go on too much because we talked about the short-term interest rates, but you can see here the 2-year had a pretty nasty sell-off here on the ZT, but that regained, a little bit about half. So definitely a bit of a hawkish repricing. The further out the curve, everything basically sold off. This is the 5-year, this is the 10-year, and let's go out to the ZB, the so-called 30-year. That's sold off, but it's also come back quite strongly. So interesting there that really the pain was taken initially by the front end. And the back end, but the back end has kind of rebounded a little bit more. Maybe, less concerned about inflation. That seems to be one of the issues there. If we're moving on to a couple of other markets here, I just want to have a quick look at oil. And actually, I just want to show you, just got the chart up. We had the oil inventories yesterday. And just interesting that we had a build yesterday of about 8.5 million from the US government numbers. So if we actually just look at a bit of historical perspective here, this is on the top left here, you see the crude oil inventory. So you see here the 5-year average is this red one. So at this time of the year, this is a number of weeks down below here. You can see here that it's the inventories here are below here, but sort of starting to build. But on a 5-year sort of average here, it's not as though the inventories are sort of massively high. So inventories did build, but if you can see here on a historical basis, we're below the 5-year average for this time of the year. And in terms of the range, we're in the sort of the lower part of the range, although we did have an 8.5 million barrel build yesterday, which is not great. On the other hand, if we look here at gasoline, motor gasoline, that's quite a different story here. And you can see that gasoline, look at that, we're actually above for this time of the year. We're in about week 6 or 7. You can see that for gasoline, sort of a lack of sort of mobility in the winter months. You can see that we actually have much higher inventories than it's much higher than even the 5-year average. Range, and even above the 5-year average. So basically, he was seeing, the distillates is doing sort of okay. But you can see the refinery demand is pretty good. Production estimate, at highs, but sort of coming down a little bit. So overall, what I would say here is that, the overall complex is relatively balanced, but gasoline is not great. So let's keep an eye out for gasoline. But of course, as we go further into spring and summer, some of that will, some of those inventories will draw down a little bit. And as you can see, the total US refinery demand is above the 5-year average. So overall, a relatively healthy sort of crude oil complex. Let's call it the crude oil complex. And then, of course, we have to layer over on top of that. We need to layer on top of that the politics. So you can see here that oil, it's been relatively constructive for a couple of months now. I mean, certainly not in the mid-50s or anything. Now, yesterday, there was talk that the Trump administration is preparing a second aircraft carrier to steam towards the Middle East, towards the Gulf states. That's a bit provocative, but on the other hand, there's also comments that the Iranians want to do a deal, excuse me, and we're talking, excuse me, sorry. So oil is being sort of, whiplash between, a relatively balanced sort of fundamental market and the geopolitical headlines. And you can see here we had a bit of a headline spike on that second aircraft carrier being prepared for the Middle East, but it suddenly, it hit it spiked up here and hit the resistance at about 65.78. So it's probably just going to sort of bounce around in this zone until and unless we get sort of more clarity on the situation between the US and Iran. In terms of the fundamentals, as I say, except for gasoline, which is showing high levels of inventory, inventory is at a reasonable level, and demand and refinery utilization is relatively strong. So I expect oil here just essentially to trade within this range. Maybe it's a question of fading, $65-$66 on technical levels, and maybe sort of buying any sort of dip down to this level here at about 62.30. So that's that. In terms of a couple of other markets, have a quick look. Just want to have a look. We already talked about the gold and silver. Kind of, some people talking about a big squeeze happening on the silver market. But at this point, we have the Chinese Lunar New Year happening at the end of this week. That means those markets will be closed for a week. Again, gold yesterday came down initially on the better non-farm payroll numbers, but crawled back a little higher, ground a little bit higher. Similar kind of situation here with silver. Silver's doing okay. Could have grind high. I think probably these things are going to sideways consolidate and maybe over time grind a little bit higher. That's my personal view. It could be wrong. But I just think, we're still waiting for the flush out. A lot of that sort of frothiness has been flushed out. So, I think especially with gold, we could now just see a steady accumulation. If we look at gold, you can see that for a long time, there were a couple of crazy moments, but essentially what the price action was a steady accumulation. And I think possibly now we're just going to get into that kind of sort of movement as well, especially as that volatility goes. People just going to start building, building, building. Just having a quick look here at crypto. I don't have a lot to say except to say that we did have an initial bounce yesterday on the strong non-farm payroll numbers, but that's actually given it back. And again, pretty subdued action, but again, nothing positive at this point. The price action remains weak. Something which is interesting, just want to have a look here at the dollar. The dollar is perplexing in a certain sense. You see here that we initially yesterday, as I was saying, we had a pretty big spike on the very strong, we had strong average hourly earnings, higher than expected, and the headline number was obviously pretty strong. Are people saying, well, hey, yeah, AI is coming to take jobs and all of the geopolitical problems and, less Fed independence and, all of these big de-dollarization, et cetera, et cetera. It is interesting. And you have to say this is concerning that even on those very strong numbers yesterday, the US dollar could not sustain the rally, and again, weak price action. So you've got to say that, at this point, the bears and that bearish narrative does seem to be winning. And I'm really asking myself what could turn this around. I think we'd have to see a combination of things. We'd have to see a lot more strong data, just continuing strong prints, so maybe another 2 or 3 months of strong non-farm payrolls. Maybe the AI story about taking jobs goes away a little bit. Maybe the US economy, we just continue to see, strong retail sales. Because remember, we did have, weak retail sales a couple of days ago. So just continuing strong data. And maybe also, when Walsh takes over, maybe he's going to show some spine, and that whole narrative of less Fed independence will slowly dissipate a little bit. I don't know, but it just seems to me perplexing that the US dollar is just finding it very, very weak at this point. Or it could just be more of a question of flows. We saw earlier in the video that a lot of money is going to Europe, a lot of money is going to the Far East developed markets, and also a lot of money is going to EM, emerging markets. So could it be also, money is maybe going a little bit more into gold, silver, sort of real assets, real estate, commodities. Maybe incrementally, all of these factors are just finding it difficult for the dollar to rally. But I'm just going to be interesting to see what if we do drift down to, let's say, 96.3. Could there be some buyers coming in? Maybe. I mean, there's also other sort of specific factors. For example, we have the Australian dollar, which was strong because the economy is doing quite well. The commodity markets are doing pretty well. Metals, industrial metals are doing, quite pretty solid. And then we had the CPI going up in Australia, and we had comments from the Deputy Governor Hauser, I think 2 days ago, and then yesterday in Parliament we had Michelle Bullock, who's the governor, also saying that inflation was, potentially a problem. So the Aussie being supported by for various sort of local reasons, so to speak. So maybe it's all these sort of local factors. We know also in Japan, you can see here that the yen has been strengthening as the US dollar against it has been weakening. Bit of a bounce for USD just this morning. We all know the story over in Japan. I won't go into that today. So, there's also these sort of specific countrywide things which are sort of driving dollar weakness. So maybe it's not all the dollar. Maybe it's also the countries like Australia and Japan have their idiosyncratic reasons for strengthening. One thing I do want to look at is the euro pound. Just quickly here, if I have some cross pairs, do I have the euro pound? Yeah. So if you look at the euro pound here, kind of breaking out, there was a nice 50% retracement bounce here. So this is euro pound on the dailies. And you can see here that if you go back all the way to May 25, you can see we had a nice retracement, bounced perfectly from this down channel from the 50% fib retracement. Now trying to get out of this downtrending channel, potentially pushing higher. And that's just because we had slightly weaker than expected fourth quarter GDP this morning from the UK. The UK also has some specific internal political unrest. There's a talk that maybe Prime Minister Starmer, there could be some kind of backroom, a backbencher, a challenge to him. For the moment, he seems to have parried that punch. But there is some political unrest there, and as I say, it looks as though the Bank of England may be cutting a little bit, a bit more, a little bit more this year. Essentially, maybe in April and a following meeting. So we have a slightly more dovish central bank. We have some internal political problems, and the real economy does seem to be softening or a little soft. And all that to say that for the euro, I think there could be a potential for a bit more of a breakout high if we continue to get some of those negative factors for the UK. Okay, guys, I'm going to leave it there for today, for this morning. So yeah, have a great day. Have a great trading session. I'll be back tomorrow with the macro snapshot from the macro shop. You can check us out on YouTube or even on Twitter. I post some things. So let's have a look at the initial jobless claims today and just continuing to look at some of those subsectors and rotation under the hood in the US equity market. Thanks, take care, and have a great day.